You don't really have any significant incremental positives that have come out over the last few weeks, but I would argue the flip side that also in December, after G20, after the Fed has also told you they're backing off, and you're seeing that some of these key risks are starting to abate, the market still decided to fall. Also, I would say on the back of relatively little news. So again, what are we dealing with? We're dealing with very low liquidity. You're dealing with some positioning being thrown around potentially by non-discretionary type strategies, and that's what you face.
The other thing we've been seeing is sort of any kind of, the reason why we haven't been able to break out of this recent thing we've been in is because any gains largely have been sold right into. You've had a dash for cash. People have been raising cash. They've used opportunities of rips to sell. Why is that going to change, Jim?
Well, I don't think it will, Scott, but I don't think that's a bad thing. I think that's the sort of volatility that I expect to continue. I agree with everyone who has higher price targets for the end of the year than where we are now, but I think the road by which we get there is very bumpy. If you take that into account, then that means these sell the rip moments, as you call them, Scott, are actually opportunities to commit cash. I think what I'm trying to say here is you should not take any day like today and say, hey, I'm putting all my chips on the table, I'm going all in on the market. You should find individual stocks that you think are great companies and wait for those days when, because of company-specific news or because of some news on the markets, maybe it's China trade deal going positively, going negatively, that you get a great price on a great company, because it's happening every week. Every week you're getting opportunities to buy fabulous, large, multinational companies at great prices. You just have to be patient.
In most instances, the market responds to institutional money flows. It doesn't respond to headwinds. So Josh might be right. Fundamentals, maybe things have not changed. And I'm not focusing on things that have changed. What I'm focusing on is the last couple of weeks look incredibly different than the time period Josh is talking about last year. The time period Josh is talking about last year, you had tremendous inflows into small caps, tremendous inflows into the high momentum, growth-oriented asset classes.
Massive melt up in January.
You had a massive melt up. So you had, from a positioning standpoint, everyone just going in and saying the world, the blue skies, the world looks great. And subsequently, yes, you're going to get that fallback of over the course of 10 days. This time is different in the sense
Wouldn't say we had a melt up from Christmas Eve. We're up about 14% in a straight line.
No, Josh, if you look at the institutional flows, we're still in net outflows. We're seeing money market funds attracting all the capital. We have not seen that capital redeployment yet on the institutional side.
Yeah, but I wonder if we're making a big leap, Liz, to suggest that we are going to see it. That you're going to have people get really fully engaged.
So we have to remember that what happened last January was largely driven by tax reform, right? Everybody was euphoric about tax reform. We don't have that this year. So now the market's looking at it and saying, do we have the fundamentals to stand on? Can the market stand on its own fundamental 2 feet? The other thing that I do think has changed, and we've talked about this a little bit, the biggest risk last year in October through December was that the Fed was going to keep plowing on no matter what and was going to ignore what was happening in the market. That risk has all but disappeared. And I say this to our clients all the time, it's really easy to go to cash. It's a lot harder to come back out of cash. So that flood to cash is probably going to stay there for a while.
I also wonder as to whether, Dubravko, the market is getting a little ahead of itself on this notion that Liz brings up, that the Fed is, disengaged now, and that the Fed got the message, so to speak, and now they're going to do nothing. If financial conditions improve in any meaningful way, if you do get the stock market to continue to go higher, you may have, and you get a trade deal, you eliminate a couple of the headwinds, you may get a more engaged Fed again.
Look, we're not advocating that the path up is going to be smooth. So I agree with your comments that this is going to be a bumpy ride. But just keep in mind that in September, we went from a Fed that was telling us it's going to go into restrictive territory. Expectations were just shooting up in terms of where rates are going to go, to all of a sudden a 180-degree turn. So I think what the market is pricing in is just simply a more reasonable Fed, a Fed that's not going to be in a linear path, take us right into the wall.